All right, so real quick, we're going to talk about consolidation or range or whatever you want to talk about. So let's switch this color here. Let's go white. Now, when you see price moving and you see it's consolidating before the move up or consolidating before the move down, that's the actually good thing. This range is a good thing. Now, a lot of people see it as a bad thing because when it's choppy like this, it's not really trending like up or trending down. And so it's hard to trade it. Now you could do some quick scalps if you go down to like the 2 minute time frame or the 1 minute time frame. These this consolidation, it looks more like this on a 2 minute or a 1 minute time frame. But really, it's just, so for you to catch it, the actual move, but to make sense, you need to go to a smaller time frame. Now, the reason it's normally bad to trade this is because just say you set your stop loss here and you want to take profit up here. So when it's choppy, you just never know how it might do. It come here, it might come here, stop you out, go back up. Then you trying to chase it. Then you trying to chase that. And then maybe you go for a call option for a buy. Then it comes back down, take you out. You got another stop. You think it's going down. Then maybe you want to go for a short. You want to go for sale. So then you get in here, stop loss here, take profit somewhere down here. It comes and go. So it's just choppy. It's not preferred to if you were in a trend. And so it's not really pullbacks like you would get if it's choppy. You come here, you set your stop loss down here, might do a little pullback, but it ain't coming down like that. It ain't, it ain't really pulling back like that. So people really don't like it. But I would say you could use it to your advantage because one thing is once you can identify that it's ranging or consolidating, choppy, whatever you want to call it, then you just got to be patient. You just got to stalk it, just lay and wait for it to break out because it's going to break out. It's either going to break out to the upside or it's going to break out to the downside. So at this point, you're not chasing it because just say you is trending and you already like is about right here. So at this point, you don't know how much further it's going to go up before it comes down. So for the most part, you chasing it. If you didn't catch it at the beginning, somewhere in the beginning of the move, then you pretty much chasing it. And so you don't know at what point it's gonna go down. So if you jump in here, you might be too late. It could be reversing soon. Or just say if you say, well, I don't know how high it's gonna go up. It's probably gonna reverse soon. And then you never know. It could keep going up. So it is better and easier to trade when the trend is going up because if you know how to restructure, and long as the structure is not broken, most likely is going to keep going up. And like me, I momentum trade, so I use the RSI, relative strength indicator. And so as long as it's above that 50%, the momentum is up. If it's below the 50%, momentum is down. So I would say it's bearish. So as long as you see what the momentum is, you can use volume however you want to use it. And if the trend is going up, then there's no need to think it's going to reverse. If maybe you use the moving averages. If your moving average is above a certain moving average, or if it's above VWAP, or however you want to look at it, then you will have no indication that it's going to reverse. So if it's trending up, you just continue to ride it up. But for the creative ones and the ones who think outside the box and want to use the range to your advantage, is a good thing. It may take a longer time because at some point the range is going to break. So that's on you. Now let me tell you something else about the range. So when you just say the ORB, the open range breakout. So just say the first 15 or 30 minutes, we'll just use the first 15 minutes. Let's say you get a candlestick. That's the first 15 minutes. So I like to make my open range line in red. So basically right here, this is your range. After the first 15 minutes, that candlestick, this is your range. So however price move within here, that's the range. And so anybody know about the range you want it to break out? Some people say as soon as it break out and they have one candlestick that closes above it, or just say if it's breaking out the opposite way, if it's breaking out to the downside, you have one candlestick that actually closed, then some people would use that as an indicator to go, short, or if it break above here and close, to go, long, to buy. Some people say wait for a pullback, let it pull back. Some people say let it pull back, and then if it rejects right here, if it don't come back into the range, then it will go up. Then that's the indicator to get in. So let's use candlesticks. So just say let's make this range longer. So this is just a wick, so that don't really count. The wick don't count. So let's just say now this is a body that closed above the range. Some people would take the trade there. Some will wait for the next candle to see if the next candle gonna hold above the range. So just say the next candle that, then people will get in. So they either will get in right here, or they will get in right here. So, but now what if it makes another range? So when you dealing with ranges like this, the price action can create a new range either within the this range or outside. So just say if this hold up. So just say this actually broke out the range, but then just say it came back in. No, hold up. Let's do this. Make it more realistic. Let's say it broke out the range. It came back in. Went back in. Came in. Let's see. Okay. So now, at this point, this created a new range. So it's been out of the range here, 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 out of the range here. So at this point, it already been moving outside the range. So at this point, this has to be the new range. Where the top of these at, the bottom of this at. So this the new range at this point. So now you want to look at after it consolidate, it was going to break out this range or this range. You can't really go by this old range, you know. Or it could have been a situation say that's the range, the ORB. You could have a situation where price action where let's see it. Let's do it like this. So at this point, the range has moved to there, down there. So that's the new range at this point. So this was you looking for the breakout of. So either a breakout to the downside of here, the upside. So that's what I want to say about using the range into your advantage, using consolidation to your advantage, using choppiness to your advantage. You just have to wait for the move. All right.